I opened NVIDIA on Invyra and checked IV engine to see the real value. Here's what came back. PEG ratio said $196, P/S growth said $208, DCF on free cash flow said $234, DCF on net income said $312, and DCF terminal value said $423. Same company, same financials, same date. A $227 spread from the lowest to the highest estimate. So which number is right, and what does Invyra actually do with all of them? Before I explain the spread, let me show you the answer Invyra gives. $261.60. 14.4% discount to the current price of $223.96. We'll walk through exactly how that number was built in a few minutes. But first, why do those individual methods produce such different outputs in the first place? Here's the core issue. Fair value is not a fact, it's an estimate. And every valuation method is essentially a different set of assumptions about the future, encoded into a formula. The concept behind intrinsic value is straightforward. A business is worth the sum of all the cash it will generate over its lifetime, discounted back to today's dollars. The logic is that over a sufficiently long time horizon, market prices tend to reflect underlying business fundamentals. Not perfectly, not on a fixed schedule, and only if your estimate of those fundamentals is reasonable. But that directional relationship is the foundation of long-term fundamental investing. The problem is that estimating future cash flows requires assumptions, and different methods make very different assumptions, often without being transparent about it. So when you see a $196 estimate sitting next to a $423 estimate on the same company, the question isn't, which tool got it right? The question is, what is each method actually measuring, and why do they diverge? Most investors respond to this problem in one of two ways. The first is to go looking for the best model. Find the most sophisticated DCF calculator. Find the analyst report from Goldman or Morgan Stanley. Use the one number that comes from the most credible sounding source. The second, and more dangerous, wiser response is to give up on valuation entirely. Nobody can actually know what a stock is worth. I'll just buy great companies and not worry about price. Both of these miss the point. Let me show you why the methods produced such different numbers on NVIDIA, because it's instructive. Take the PEG ratio at $196 versus DCF terminal value at $423. These aren't two versions of the same calculation with slightly different inputs. They're measuring completely different things. The PEG ratio anchors to current earnings and expected near-term growth. It's a relative measure. It tells you whether the current market multiple is justified by the growth rate. It says nothing about what the business will look like in year 15. DCF terminal value is almost the opposite. It's built on long-run assumptions. What growth rate does this company sustain in perpetuity? What discount rate captures the risk? And because the terminal value, the value of everything beyond the forecast window, typically represents 60 to 80% of a DCF output, small changes in those long-run assumptions create enormous swings in the result. To make this concrete, I use Invyra's own DCF assumptions as a starting point. Discount rate, 8.6%. Year 1 to 5 growth, 30%. Year 6 to 10, 12.5%. Long-run terminal rate, 5%. That produces a per-share value of around $246, which is Invyra's DCF cash flow estimate. Now watch what I do with Invyra's own calculator. I change just one input, the long-run growth assumption, from 5% down to 3%, 2 percentage points. The fair value drops from $246 to $234. But that's not the interesting part. Look at the verdict. It just changed from undervalued to fairly valued. Same company, same cash flows, same discount rate. One assumption shifted by 2 points. And the conclusion about whether this stock has a margin of safety just flipped. That's what DCF sensitivity means in practice. It's not abstract. It's the difference between this stock is cheap and this stock is fairly priced, determined by a single number you can't actually know with certainty. So, the $227 spread across methods isn't telling you that some tools are broken. It's telling you that different time horizons and different value drivers genuinely produce different answers for a business like NVIDIA. That information is useful if you know how to read it. This is what Invyra's IV engine is designed to help you navigate. Let me walk through the full picture. You can see Invyra's valuation methods laid out on a radar chart. Each spoke is a different approach. The current market price of $223.96 is the dashed line. The blue shape is where the methods land. The DCF terminal value at $423 is visibly the outlier. It's sitting far outside the cluster of other estimates. Invyra's system identifies and excludes it from the composite. Again, this doesn't mean that model is wrong. Terminal value models often produce extreme outputs for high-growth businesses, and reasonable assumptions can still justify $420 for NVIDIA over the long run. But including one outlier that's 70% higher than the next method would distort the composite in a way that reduces its usefulness. After that exclusion, the remaining methods, ranging from $196 to $390, are weighted to produce the composite. $261.60. 14.4% below the current price. Calculated July 31st, based on financials through April 2026. Now let me show you the rest of the page, because fair value is only one input. Invyra chart IQ, 7.9 out of 10. This is a composite quality score across 6 dimensions of business health. Durability, 10.0. This is the moat dimension. How defensible is this business? NVIDIA's CUDA software ecosystem has been built into the workflows of virtually every serious AI researcher and enterprise data center on the planet. Switching costs are significant. Efficiency, 9.6. How well does the company turn capital into returns? Momentum, 9.2. Business trajectory. Is performance improving or degrading? Resilience, 8.4. Balance sheet strength, debt levels, capacity to absorb shocks. Opportunity, 5.9. Valuation opportunity relative to quality, the lowest dimension, which makes sense given where the price is relative to the fair value range. Clarity, 3.7. Earnings predictability. This is the one signal worth pausing on. A 3.7 on clarity reflects the genuine uncertainty in forecasting NVIDIA's earnings trajectory. At the scale and growth rate it's operating, consistency is harder to model. ROIC versus WACC, 70% versus 15.5%. That's a large spread between the company's reported return on invested capital and its estimated cost of capital, indicating that historically, NVIDIA has generated substantially more return than what its capital costs. Whether that spread is sustainable at this scale is one of the central questions for anyone trying to value this business long term. Financial health, 4 out of 4. ROIC, 70% against a target of 12%. Debt servicing, 0.2% against a target below 0.4%. Current ratio, 3.91. Debt over EBITDA, 0.08. The balance sheet is nearly debt-free relative to the earnings power of this business. Revenue, $215.94 billion, up 65.5% year over year. Net income, $120 billion. Free cash flow, $96.68 billion. Net margin, 55.6%. Now the flags. PE at 45.2, elevated. PS at 25.1. That's paying 25 times revenue. These multiples are pricing in continued high growth. That's not automatically wrong for a business growing revenue at 65% per year. But it means there's very little room for the growth narrative to disappoint. Prism signal, accumulate, plus 55, high confidence. Direction bullish, quality bullish, confluence bullish, though momentum and timing are flagged bearish, meaning the short-term price action has some hesitation. Overall, Prism is reading this as a constructive setup with some near-term caution built in. SMI, plus 38, bullish. Institutions and insiders are actively positioning. A different signal than what I would have shown you a few months ago. Pulse, 75, greed. The market-wide sentiment is running warm. That's context, not a verdict, but it's worth knowing. Here's how I think about what we just walked through. Invyra's composite fair value is $261.60 against a market price of $223.96. That's a 14.4% discount. For a business with a 7.9 IQ score, a wide moat, 4 over 4 financial health, and a Prism signal saying, accumulate, that's a more meaningful margin of safety than a 5% gap would be. But I hold that number with appropriate humility. The clarity dimension came in at 3.7 out of 10. And that's telling me that even Invyra's models recognize NVIDIA's earnings path is genuinely hard to predict right now. The AI infrastructure built out that's driving this growth is real. Whether revenue at this scale continues growing at 30% annually for the next 5 years is a legitimate open question. The elevated PE and PS ratios reinforce that. You're paying for a growth narrative. If that narrative holds, the current price looks cheap in hindsight. If it slows faster than expected, that multiple compresses quickly. Would I be watching? Williams %R is reading as overbought in the short term. The stock has moved a lot quickly. That doesn't invalidate the thesis, but it does suggest the entry timing matters. The framework I use, fair value, gives me the anchor. The margin of safety tells me how much cushion I have if I'm wrong about some assumptions. The IQ score tells me whether the business quality justifies the confidence, and Prism tells me whether the setup is constructive right now. On NVIDIA today, the fundamental case is strong. The margin of safety is real. But I'd want to see the short-term momentum stabilize before I'd act, because right business and right business at the right moment produce different outcomes over a 12-month window. That's my process, not a prediction, not advice, a framework for thinking about it. That's a wrap. If you found this useful, like and subscribe. More videos like this are coming. Invyra link is in the description.